Hey, Max here. In this video we're gonna dive into the Wyckoff method, a method I'm gonna show you that is used by many traders because it is giving them good results. It's a well-known concept, but no one really has a good breakdown of it, and that's what we're gonna cover in this video. So let's dive into the charts straight away. What do we have? We have here a drawing that I created, an A, B, C, D, E system. And yeah, let's dive into the full trading plan, how you can apply this for yourself on the charts. And at the end of the video, I'm gonna show you how this looks automated. So if you don't want to sit behind the charts and you just want to have a system run for you that's exactly trading this strategy, then I will introduce that to you as well real quickly. But let's dive into the charts because that's why we're here, to learn this powerful method. So if I zoom in here, we are on dollar yen, the 1 hour time frame. It doesn't really matter on what time frame you're using this on, but right now we're gonna show you an example here. We have this A, B, C, D, E pattern, right? The first part here, what is super important, is consolidation. You have markets that trend and you have markets that consolidate and range. The clear example is here on the charts. We have this trend here to the upside, and then price tanks and then consolidates. It takes a rest. That's how markets move. If you're a breakout trader, you know that taking all the breakouts will result in you taking trends eventually, but it's also sometimes the case that you take a breakout, it is a false breakout like here, and if you have a false breakout, then you go back into the range and maybe start the trend the other way around. So that's a really important concept I had to learn when I started with trading. So consolidation, that's the first thing. Then price moves from C to D, like a big leg to the upside, breaking price, where buys are triggered here with the breakout, people are expecting a new trend. But instead of that happening, price reverses, breaks below that range high, and then rolls over, and normally we then see a big move to the other side because we trapped these buys and now they're all stuck in their buy positions and they're gonna exit because emotions flip in, or they think, the markets are shifting, we need to get out, and that's more fuel for the markets to move to the downside and often even start a new trend in that opposite direction. So this is the whole pattern. Let me now dive into the trading plan. 5 simple steps. Let's see if I can increase the size so everyone can read it. And there we go. So step 1, what I have here is find consolidation of price. This is a very subjective thing. So what is consolidation? Is this consolidation? Is this whole period consolidation? How to define that is to have a limit of bars you are looking back to. For instance, if you classify this as consolidation, count this range. How many candles are here? How long is price not really doing anything? For some people, they are waiting for consolidation that is way longer, like for days. Right here you can see with my cursor, Monday and then Tuesday and then Wednesday. So this is a big range. After this range, probably we get a big breakout either to the upside or the downside. So you can test these things. Is it a small range or a big range? How I really defined consolidation periods in like a formula is by using these imbalance candlesticks. On our channel, I've shared it before. I have this big masterclass I'm gonna show you here. This big masterclass talks about a very profitable strategy and building that with no coding, full masterclass, and that utilizes these imbalances. But in a nutshell, what is an imbalance? Well, those are these white candles. And this is one white candle classifies as a consolidation of 1 hour. Then if I move to the 15-hour chart, random chart, then what we see here is these imbalances are consolidation periods of 15 hours. So that's how I define the consolidation in the markets. It's not something I do by eye. I really want to have a formula, and the formula is this imbalance candlestick pattern that I created. You can find it under indicators and a new capital imbalance, I think it's called. With that said, find consolidation of price. So personally, I look for a longer term imbalance to happen, but I'm gonna dive into it further. Like this whole video, you get nuggets, therefore you should watch the whole video. Step 1, find consolidation of price. So that's this part between A and C, is how long the consolidation is. And what we find important is the A level and the B level, like how high the consolidation is. So you want to see how wide it is, but also the height of the consolidation. Second thing, measure consolidation height. How do you do that? Well, you take the highest price minus A, the lowest price. So that is, let's say, real quick, 150, 300 and 149, 500. So you take B minus A, and then you have the consolidation area. Why do we do that? Well, that's because this part is added to B, and then you have the cancel level short. And this is important because you need to define for yourself, okay, we have consolidation like this, and then we have a breakout to the upside, but how far do we break out until we break out so far that we just started a new trend? So let me draw that out. Maybe this happens, right? And then you need to have a cancel level. That's how I call it. When is it not a fake breakout? So that's how we define the cancel level, is by 2. And then 3 is then calculate the cancel level, which is B minus A plus B. So you take this height and you add it here. And then you have the cancel level. You can also make that level bigger, shorter by just adding a formula to it. But normally it's just A and B and then added on top of B. And then you have somewhere here that cancel level. So when price moves, breaks out and moves too high, I'm not looking for a fake breakout anymore. If we then do decide that we print D, and D is obviously the high here, and we do roll over, we are waiting until we break below the breakout level, and that's that B, this red dotted line. Then if that happens, we have a fake breakout. We broke to the upside and we rolled over. And if this happens in a short period of time, like a few hours or maybe sometimes a second or a few minutes, you can define that obviously, but if it happens within the session or within the day, it's also fine, depending on what time frame you're running this. Then I want to enter short on C. So if we break the leg of C, you can also, if there is more structure here, you can also select this as your short trade. Then you have a slightly better risk to reward. Maybe your stop loss here or stop loss here. I'm gonna show you, and then your target. So this is the pattern. So let me repeat it quickly. Find consolidation of price. Price is consolidating. Measure consolidation height, and then add it here. Sorry for my ugly drawing here. It's the knowledge is good, but my drawing skills is not why I'm here. Calculate the cancel level. We have done that. Wait for price to create that fake breakout, and then form D, and then place an order to trade the other way. So you can just place an order here. This is the strategy. And manually to trade this is pretty easy. I'm gonna show you how this works. I'm someone that just automates this whole pattern just simply by no coding and using Profectus AI, our platform. But yeah, this is also doable if you want to do it manually. Let's go back to that 15-hour time frame. Let's assume, okay, the consolidation period is 15 hours. What I'm gonna show you then is this particular setup. There are way more. I'm currently still testing this strategy a lot. But here you have consolidation for 15 hours. So one imbalance right now, one candlestick equals 15 hours, right? 15 hours are squeezed in that imbalance, which defines the range. So if we go now back to the 1 hour, and what we can see is, okay, we need that high, and we need to get like the low of price, right? The low can still form. We want to see a fake breakout out of this consolidation. So the pattern was, you have consolidation, you break the consolidation, you come back below that breakout level, and then you trade a different direction. That's the pattern. Okay, what do we have? This is the breakout level. We are waiting for price to break above it. There you go. And then we enter on the low here. That low was formed. Then we had to break out. We came back, and now we're shorting the markets. Stop loss placed here. You can also optimize it. Of course, if you have automated this, you can optimize in minutes what is the best stop loss, what's the best target, what management style should I use. You just run, let's say 100 or a couple hundred back tests over 5 years of data and see what the best settings are. But if you do this manually, it's a little bit of manual work. That's why I don't like to do that, but everyone his own trading style. Then you enter short, and then you wait for price to roll over, and then you can add management or whatever you want to do, add that to this system. I really love this strategy. It has a lot of variables. That is one thing. You have the first thing you need to consider for yourself. Okay, what is consolidation? So how long is that consolidation period? And if you define that like 15 hours, like what we shared with this setup, perhaps that's the best, but you can also do 5 hours, 4 hours, 12 hours, 24 hours, and then just define for yourself, okay, what is a nice consolidation area? And then the second variable is, okay, where do you enter? But that is easily done by just looking at the lows and then entering the lows. And then the only other question you have, what is your risk to reward? And what's your stop loss size? I like this. I like the way I described it to you. Now let me show you real quick in Profectus AI, just that you have an image on it, how it looks. So within Profectus AI, you have here the whole system. So it's just a few blocks. We have this part, and this part, and then a small part here. These are all the blocks you need to use to create and automate this Wyckoff strategy. Like I said, no programming is involved. It is just drag and dropping the right blocks and then putting within the blocks the right settings. If you want a tutorial that I share this with you, the strategy, but also how we build it, comment below, and then I'll consider making a video on this channel describing all of that, the full masterclass. If you want to have another good strategy, really watch that other big masterclass that I shared before in this video. I'm gonna link it again here. Watch that masterclass. I just made it, and it's a super powerful strategy, and I highly recommend it. But this strategy is also one of my favorites, and we have hundreds of more. So on this channel, subscribe below, because we're gonna drop a lot of strategies in the coming months ahead. See you in the next one.